All right, so we will start. But before we start, it's important we try to have a common understanding of what we are trying to achieve for putting up this topic, particularly in this month. What is our objective? Our objective is actually, we've looked at in the practice, a lot of people has knowledge gap about deferred tax computation and where they could actually prepare deferred tax computation. They hardly have a good understanding of the implication or the application of this in practice. We've seen instances whereby I was engaging one CFO the other time after we completed the audit. We have about their current tax positions, it was about 10 million, and they now have about deferred tax about 52 million. So the man just jump up that, oh, Shibi is good. So you can use that deferred tax asset to offset whatever. I say, it doesn't work this way. And engaging a lot of other people too, we notice that that's misinterpretation is always there too. So that is what actually informed this. But we don't just want to jump at deferred tax as it is. We want to have what even inform the standard that give rise to preparing financial statement on its own. That was why we had to start with IS1, after which we'll be considering Ifrs 1. That is the first time adoption of Ifrs. Then we will now deviate majorly into tax, computing CIT, education tax, and other related levies before we now consider deferred tax as it is. That is IS 12. All right, so I am Adekunle Cole. I think this is the first time Femi is meeting me for. All right. So let's go on. Usually when we organize training of this nature, you might just need to note very important things on your jotter, but we'll always share the slides and the recorded video section so that at your convenience, you can listen to it. And the essence of that WhatsApp group is for us to be able to disseminate peculiar information to the participants. Then even after the completion of the program, of the training, should you have any work-related issues, you can always bring it up on a platform. All right, as simple as IS1 is, there are a lot of insights we need to have about it because there are some updates that have been made on it, even in 2020, that will now be effective 2023. So we'll be looking at that as we go on. In the course of this, we'll be looking at the introduction to the standard on presentation of financial statements. When was the first time the standard was actually introduced? Along the line, what are the issues that necessitated making amendments or revisions to the standard, and where are we today, right? As an accountant, what are the expectations of us? What are the issues as required by IS1 that we have been taking into cognizance, but we don't know why we're actually doing it? And there are some that we also have been taking into consideration, but we have not actually been doing such. So after which we look at the objective of the standard, what does the standard actually seek to achieve, right? Then what are those areas the standard covers and what are those areas that are not covered by the standard? That is the scope of the standard, the key definitions. The standard actually gives specific interpretations or meaning of certain terms used in the preparation of presentation of financial statements. So we need to have a good understanding of what those key terms were. Then why do we actually prepare financial statements? As noted in the standard, we'll be looking at that too. Then the complete set of financial statement, what does it actually contain? What are the things that we should see in a financial statement? What are the things we should not see? I often like asking this question when I'm taking this topic. Why do we prepare value-added statement? What is value-added statement first, and why do we prepare it?
Value-added statement
Okay. Okay, if that is the meaning of it. Good. Why do we prepare it?
Reason B. To have
Okay. Let me put the question in another way. We know why companies pay tax because the tax law says we should pay the tax. Which tax law? Company income tax for the case of incorporated entities. For the sake of individuals and other unincorporated entities, we're referring to Peter. Why do we prepare value added?
Okay. The reason would be that okay, as you try to compare it with company that want to know
yeah, exactly. That's what I want to know.
Okay. Value added tax.
No, value added statement.
Value added statement.
It's different from VAT.
Okay. That I must say.
Oh, okay. But you prepare it a number of times, huh?
Well, I do not work in the core accounting.
Okay, what do you do? So maybe that will also help me to be able to put you in the right perspective.
So, what I work with finance, so I don't have to cost control
Okay.
But I know that I have shortfall in that aspect.
Okay.
That's why I seek more training.
Okay. I think I now understand. You're almost at par with her. She handles an aspect of the whole financial reporting, which is income, right? Okay, so I think you will have you will have a lot of insights into this, and as a way to actually open you up to other opportunities in accounting, right? All right. Generally, we prepare value-added statements. It is as dated back as when we used to use statements of accounting standard. And a lot of people then think that the standard actually compels us to prepare it. Unfortunately not. What actually mandates us to prepare value-added statements is it's one of the requirements noted or expected of directors as contained in CAMA, Companies and Allied Matters Act. Yeah, you know. Yes, because the Act actually provides certain responsibilities of directors to prepare financial statement, but to include VAS. And upon the adoption of Ifrs in Nigeria in 2012, which transits between that period to 2015, it is expected that every organization now who are expected to make financial reports, whether publicly quoted or operating as an individual or unquoted entity, should strictly adhere to what the standard says, right? The standard does not forbid you including as many information as possible, right? And it does not say you should not disclose much more if you so choose, but what the standard expects that the ones that are within its scope, you should do it or present it in line with what it has prescribed. So you still see a lot of entities preparing statements, or value-added statement. They are not doing that in obedience to IFRS, even though IFRS will not forbid you to include in that. You will also see that when you have an audited account, there is a page which we call the director's report, right? It's not noted in IAS, right, or IFRS, but you will definitely not have a complete, the directors will not be able to give a complete perception of what actually happened, their stewardship role, if they don't include all other information, right? So you will, at the end of this section, you will know exactly what are the things the standards specifically say you should do if you are performing your role as a financial accountant. The scope of this will be expanded by the time I now shift my focus as an accountant to considering or speaking as an auditor. You understand? When I'm doing that, I will then be expected to adhere to whatsoever the standard says, whatsoever the rule-based regulations, the BOFIA, the CAMA, the Insurance Act, name them, whatsoever they have said. But my responsibility will then be tailored strictly in line with what we have or what we call ISA. What is ISA? Of accounting? No. International Standard on Auditing. So I am financial accountant adhere strictly to the IFRS, and IFRS can include both the real IFRS and the one before the use of the name IFRS, that is the IAS. But we auditors, what guides what we do is ISA, even though ISA will not say anything that will contradict this. You understand? It will really give you an expanded view of how to review or confirm or give your opinion about what assertions the directors must have reported in their financials, right? So we'll be looking at what actually makes a complete set of financial statements as expected or contained in IAS 1. Then what are the general features expected of any financial statement within the scope of IAS 1? Then structure and content. In which form, when you say you prepare your statements of financial position, in which form should it be? When you say you prepare your statements of profit or loss and other comprehensive income, how should it look like? And that also includes statement of changes in equity, your statement of cash flows, your note to the account, your statement of accounting policy and the like. What are the cogent things you should find therein? So that's what we'll be looking at within that context. Then what is the transition and effective dates, right? When this standard was introduced, it specified the date that it should take off, or the date compliance is expected to be adhered to. However, we'll also be looking at what are, if you so choose to adhere or adapt this particular standard earlier before that date, will you then be conflicting any provision of the standard? Do you understand? The last one is the withdrawal of IAS, which was revised in 2007. Please, as we go on, it will be very engaging. It is 75% theoretical, but we'll try as much as possible to make it very lively, because here, this standard does not tell you how to prepare anything. It's just telling you what is the form. And to bring it home, I will show you typical examples of client reports that we have done. You see you confirm some of the features we mentioned here, flipping through the financials, seeing whether it is there. It is only when you have a good understanding of what you want to do that you can do it better. Imagine as a building contractor, you can't initiate or embark on any building project without having the view of what you want the actual output to look like. That's exactly what IS1 is trying to do, giving you an objective view, a skeletal view within your mind. What is the form, the content, the structure of what we often call financial statement? Are you ready to ride with me?
Yeah.
It should be very, very interesting. All right, so I will trace the history. What is the standard history? You often agree with me that IAS was never our thing in Nigeria. Our usual thing used to be SAS, Statement of Accounting Standard. Which is the body that issues SAS? Yes.
Nigeria?
Yes.
NASB.
Okay, NABS here. Now, when we use IFRS, which is the body that issues IFRS? No, IASB ceased to be. With effect from 2011, what did I say? NABS ceased to be. Now we have FRCN. FRCN. FRCN means? All right. Okay. So in April 2001, the International Accounting Standard Board adopted IAS 1. Now, why was this? It then means that there was a body before 2001. Actually, okay, let me even take it a bit further. IASB was actually a body of worth. We know we can attach FRCN to Nigeria. What can we attach IASB to? There is a body, we call it IFAC. So it's not attached to any country. It's actually a distinct body on its own that regulates accounting practice globally, right? So this body used to have a committee, which we can call a branch of its own operational process, that we used to call International Accounting Standard Committee many years back, before 2001, right? So with effect from 2001, that committee was actually changed to IASB. What informed the change? As at period before that 2001, any standard issued by this committee is actually called IAS. But the acceptance, universal acceptance of IAS was actually limited in scope. So as a way to actually sell that acceptance to as many countries as possible, there was a need to actually rebrand that committee, rebrand the makeup of that committee, and rebrand their outputs, right? That's what informed IASC being changed to IASB. So as at when IASB actually took over, they didn't disregard all the works or the existing standard as published by IASC. They still adopted it. So you will often see at the beginning of every standard where we often see in so time when so thing was actually adopted. Are you with me? So in April 2001, the International Accounting Standard Board adopted IAS 1, which is presentation of financial statements, which had originally been issued by IASC in December 1997. That was the very first time it was then introduced, right? IAS1 presentation of financial statement replaced what we used to call IAS1 disclosure of accounting policies, right? That was a formal name given to it. I'm trying to drive home a point, which was then issued in 1975. Then we used to have this disclosure of accounting policy was rebranded in 1997, right? Then we have IAS 5, which was information to be disclosed in financial statement. This was actually originally approved in 1977. Then IAS 13, presentation of current assets and current liability, which was initially introduced in 1979. Now, you will notice that as of today, if you want to check a list of all the standards we have, you won't see IAS 5, you won't see IAS 13. Why? Everything has now been encapsulated in our revised IAS 1. Do you understand? So gradually they are trying to phase out all the phases of IAS, right? So that's what happened there. Then there were no other, there were other amendments to IAS 1, that is, after that 2001, there was an amendment to it in 2003, 2007, 2011, 2014, 18, and January 2020, as well as July 2020. Now, we will pick what are the unique changes that occur. Some of them is just a change of name, change of structure, additional requirements expected to be adhered to, but materially, the name, presentation of financial statement did not change. Do you understand? Now, below are the highlights of unique changes or updates made on the substantive IAS 1. So in 2007, between what then happens in 2003, no material change other than change of name. So that's why I didn't pinpoint it in particular. In 2007, an amendment was made to presentation of owners of changes in equity and comprehensive income, and change in terminology in the title of the financial statement. So that was when we then we have a substitute for what we used to call profit or loss and loss account to statement of profit or loss. Do you understand? That was when other comprehensive income was actually also introduced. That was when a segment of the owner's equity was removed from the balance sheet, and we prepare a separate statement for it called statement of changes in equity, right? So that was a unique change that occurred there. In June 2011, right? For you to be able to perform your work as an accountant, you don't need to cram all of this. All you just need to know is know that this is the current position, but for illustrative purpose, we just want to draw your attention to some of those areas, right? So in June 2011, amendment was made, was to improve how the items of other comprehensive income should be presented. So we'll be doing an expanded content of the other comprehensive income as we go on. You will see a lot of things because there used to be this misconception. At what point should I present an item in a profit or loss statement, and at what point should I present another transaction in the other comprehensive income? Can you tell me, Henny, that what is the distinctive factor?
For those items, let's say of income and loss statutory, I think we should fall on the
statutory like?
Okay, like interest on savings.
Okay.
That's when you set up a business, I think that is not a mistake. So it should not be totally. It can't be a line item. So that I think that should not fall on that.
So I remember as far back as in the early 2000s, right? Even in then, before we get qualified, there used to be this hot argument around what should be here, what should be there, because the standard was not very clear, right? So most of the time, we actually use our personal opinion to say, well, I will just justify it and make the disclosure out there. But you will see as we go on what actually informed what should be here and not there, and what should be here and not there. So in December 2014, changes or amendments made include concern raised about some of the existing presentations and disclosure requirements in IAS 1. and ensure that entities are able to use judgment when applying those requirements. Even though the drafter of this standard attempts to make it as simple and applicable as possible, but the more they make those amendments, the more other complexity give rise, right? So at this particular period, there are some transactions that you actually have the opportunity as a director or the reporter of the financial statement to make some personal judgments. Do you understand? And oftentimes you might also have encounter around transactions that what the standard had say or how the standard had say you should report it will not actually reflect the actual happening. So the standard also gives you the opportunity to say, oh, in this area, I'm not using what the standard says. I want to use my opinion, believing that my opinion or my approach will give or reflect a better or a true or fairness of what actually happened. Is that clear? So amendments made in 2018 was to introduce the definition of material. What is actually material? Until date, there is still this ambiguity. What is material? What is material to company A may not be material to company B, may not be material to company C. So at what point do we actually define what is material? So in 2018, an expanded view of what or instances that could give rise to materiality or immateriality was actually talked upon. And that is tied to IAS 8. Please, IAS 1 did not say this is how you should do anything. It is just telling you the form, the nature, the structure. How you will then address all of the form, the nature, the structure is around how do you identify and report assets, liabilities, income, equity, provisions, and expenses. Do you understand? But how you then address each of these will be specifically provided for in other specific standards. So you won't be a good accountant if you just say, oh, I have known IAS 1, I don't need to know what other standard talks about, right? The form and the content or the recognition criteria, how you measure, and the disclosure of what you expect to do in respect of each of the accounting elements are catered for by distinct standards. Is that clear? But IAS 1 actually laid the foundation. After you must have measured it, after you want to present it, you have a disclosure you want to make, where and how where do you put it? That is what IAS 1 is actually giving framework around. Do you need water? So the amendment clarified in the definition of material and how it should be applied, including the definition guidance that until now has featured elsewhere in our IFRS standard, and improving the explanation and accompanying the definition and ensuring that the definition of material is consistent across all IFRS standards. So that justifies or further expand what I explained before. So if you get to, say for example, IFRS 9, the most troublesome standard, when you now want to look at what is material or not, will then be addressed specifically by that standard. What is material within the plight of IFRS 17 will then be specified within that particular standard. Remember when we had a class on IFRS 16? IFRS 16 is what? That was one of the topics we had last month. So bail amount. Lease, good. So it was on leases, right? How do you account for lease? Is IFRS 16 a total replacement of the old standard IAS 17? No. Do you understand? There are still some provisions that IAS 17 will still be relevant and IFRS 16 will still be relevant in other areas. One of the unique areas with regards to materiality here that was mentioned in lease was that Unlike before, when we used to have a finance lease as different from operating lease, IFRS 16 combines the two. That's no such distinction again. Now, but it still give you the caveat that you may then have some lease transaction that are of low value. That concept of low value is coming out of what? Materiality. That you don't need to do all those complex calculations, restatements, and all of that on low value assets, right? And the US GAAP was actually able to specify what actually equals a low value asset. We are expecting that FRC will be able to come up in Naira terms. What is low value asset? They've not been able to come out with anything. But US GAAP actually provides that, oh, within their own plight, anything below $5,000 is a low value asset. Do you understand? But you know, our people are hoping that they'll be able to come up to speed. But in the interim, if you then find yourself in that space as an accountant, what do you do? Right? If somebody has a lease arrangement of about 90 million and you have yours to be 1.5, do we say it is a low value asset as opposed to the other? It may not still be a low value asset depending on the status of that very company. Then further buttressed by the duration of the lease, right? If the duration of the lease is still more than 1 year, right? Even though it appears as though the value is low, you will still have to adhere to or treat it as a finance lease. But usually the general canon that we use in Nigeria is that the moment that very asset, leased asset, is within a period of 1 year, treat it as a low value asset. Do you understand? All right. So in January 2020, classifications of liabilities as current and non-current was made as amendment to IAS 1. So before now, we don't have that major distinction. What they often say is liability that are used up within 1 year and above 1 year. Even though it's just nomenclature they are changing and a little expansion of what could come under each of the categorization, we just still have to ensure that we adhere to it strictly. The requirement for an entity to have the right to defer settlement of the liability for at least 12 months after the reporting period. So it then says that when you have a liability, even though it appears small or big, but if you have the opportunity or the privilege of deferring the payment to a period later than 12 months, irrespective of its size, they classify it as what? Non-current assets. Okay, that brings me to this question. If you are preparing the financial statements of a company, sorry, give me a minute. One of the candidates wants to come in. So just sit on there. Sorry. All right. So, where do we stop, sir? Okay, that's in line with the provisions, what the amendments made in January 2020. Now, in July 2020, we have not done much, we're still trying to look at the history of IS1. In July 2020, the board issued classifications of liability as current and non-current, deferral of effective date, which differed the mandatory effective date of amendment to IS1 classification of liability as current and non-current to annual reporting period beginning in this date. So as we speak, that major amendment has not been very effective. But accountant of today, which feels that, oh, nothing stopped me from starting to adopting it now, you can choose to adopt it. But every the reporting councils will then be enforcing that anything after January 2023. So don't be surprised when you are in a discussion with some of your colleagues and some people are still arguing that, oh, this thing does not occur, it's not there and all of that. These are part of the recent changes that have been made to IS1. So the change continues to occur year in, year out as a standard setter consider it very effective or relevant. So that is what we need to know as far as the history of the standard is concerned. Just like I said, by way of quick revision, IS1 does not teach us how to prepare financial statements, right? But without understanding of how a financial statement will look like, you will probably not be able to prepare a good one. So the guidance the standard actually gives us is what actually informs a financial statement. How should it look like? What are the contents? What are the form? What are the structure? What are the subcomponents? How do you make an accounting policy, right? So, and please, I will advise you that you pay attention to this because for those people who might be considering the option of diverting into consulting later on in years, these are areas where you render value-adding service to clients, right? And even as you are in what you're doing at the moment, if you then have an opportunity to be in a role where you engage the auditor, you will not only know what you are saying, but you know why you are saying what you're saying. Do you get what I'm trying to say? So please take it with pay absolute attention to that. One thing that stands out different from every other professional, not that we are better than anybody, is we lay emphasis on you knowing why you are doing what you are doing, right? So objective of IS1, what do you think IS1 seek to achieve? What is its intent, right? Every standard introduced by the standard setter will always provide its objective, right? So if you don't know anything at all about the standard, know the name of the standard, know the objective of the standard. Your understanding of the objective of the standard will then inform your order or further engagement of the standard. But I just like this popular saying that when the purpose of a thing is not known, abuse is inevitable, right? So this is another very important area that we should pay attention to in this session. IS1 prescribed the basis for the presentation of the general purpose financial statement to ensure comparability both with the entity's financial statements of previous periods and with the financial statements of other entities. So what does this mean? We recognize that every entity, there should be an entity in the first place, and such entity must prepare financial statements. And when they are preparing their financial statements, it must have it must have that comparability features, meaning that if that year is not the first year you are preparing the financials, you must have comparative of what has happened in the prior years. Do you understand? Then information contained therein should be presented in a way such that you can also compare that company with other companies of similar standard. Do you understand? So not that you just make your own peculiarity so unique that when other company picks your financial wanting to looking at it, it looks like they are reading the dictionary. And I've seen instances whereby accountants just use some nomenclatures in the accounts, not paying attention to what has happened in the prior years. Let me give you a practical example. Imagine you are the auditor. I'll give you an example as an auditor, and I will give you an example as an accountant. Imagine that I just took up an accounting role from an outgoing accountant, and every expenses with regards to entertainment, the formal accountant used to report it as meal. Okay. Do you understand? I'm now coming in because I want to impose that, oh, I know better than this guy. I change that nomenclature. Do you understand? As simple as it looks, it will misinform the users of the financial statements. So, but the standard, as you will see later on, give you room where you want to make that transitional changes. If you then will have to change even as little as the nomenclature, you need to show that transitional statement where we used to have it as a meal, but for reason which we have also disclosed, because you must also justify that change. So don't just say, oh, before it was meal, now we have moved it to entertainment. Tell the users what informed that change. Do you get what I'm trying to say? So also as auditor, because some auditors too could be very funny, wanting to impress the management that, oh, this thing should be like this. No, you have to look at what is the approach that has been used in the prior accounts. If you think for any reason, what they have disclosed in the prior account is not justifiable, the nomenclature and everything is not justifiable, bring up your justification for making that changes. Do you understand? Otherwise, you will be as good as your report may be, you will have violated this. And you as an accountant or an auditor are expected to uphold the content here, not to make things worse than how you met them or leave people more confused than how you join them. So IS1 prescribed the basis for the presentation. You will be looking at in the subsequent slide, how do we present a general purpose financial statement? And then what is a general purpose financial statement? We look at that to ensure that what you have prepared as your general purpose financial statement has that comparability features. When we say comparability features, it means from year to year, company to company, we can benchmark, right? Both with the entity's financial statements of previous years and with the financial statements of other entities. That's one. It sets out overall requirements for the presentation of the financial statements, guidelines for their structure, and the minimum requirements for their content. You see, mark the word of the standard, minimum requirements. You can then choose to say, I will adhere to everything the standard has said, but I still want you to include more. Do you understand? You see you see of recent times now that auditors, particularly the Big Four, we also include environmental impact assessments on financial reports. It is not a requirement of the standard, but the standard does not forbid you bringing in more. Anything you feel that it will make the users of the financial statement to be better informed, right? You can include it, but don't report less than what the standard has prescribed. Is that clear? All right, so that is the major objective of the standard. It's as simple as that. Make sure that you present your financial report, at least for the general purpose one. You notice that I keep on emphasizing the general purpose one. The way your management accounts will look like may not be the way the published accounts will look like, right? Because you actually needed the management account for various purposes. You can decide to use anything you want. You can decide to put it in any form you so prefer, right? But a general purpose one must adhere strictly to the provision of what? IAS 1. So what are then the scope? What are the scope of IAS 1? What are the things the standard actually covers? And what are the things that are beyond the provision of the standard? I think I've emphasized it at the beginning of this class that IAS 1 lays the basic foundations of what should be the form and structure of any financial statement, but does not tell you how you measure PPE, how you value inventory and all of that. So it gives relevance to other standards to ensuring that what it's saying you should do, right, is not in conflict with others, but it pays attention to the form and the structure, while other standards will give you guidance on how to doing it. So that then will bring me to this question: which is the most important standard among all the standards we have? There is none. They have equal importance. That's my point.
Well, I want to agree with that because the basis of your role as an accountant is presentation of financial statements.
Yes.
So every other thing is secondary. If you are employed as an accountant, well, what's number one thing that's instead of you is maybe to let me see. Okay, give me the activities we've done for a year or so. Though other standards too still have a place because you cannot think IAS 1 is just solely amidst the rest. So they all still interweave with the rest. Okay,
I will bring forward a quick story that one of my mentors told me when growing up, that there is a competition within all parts of the body. Which one is superior? The head says, don't you know that I'm the one that thinks? The eye says, I see. The nose says, I smell, without which, and all of that. So there is now this question: among all the parts of your body, which one is the most important one?
Are you still asking?
Yeah, I'm still asking.
The heart now.
There is actually no one that is superior.
The heart stops pumping blood, everything is shut down. Okay,
let me give you an illustration. Even if the heart is pumping the blood and the man refuses to accept the food,
you still be alive.
How long? Is the timing different?
You still be alive. They can give you artificial meal.
Where is the artificial meal?
They can pass me to your belly or wherever.
The belly too will refuse because it's a competition between all parts of the body.
Yes.
Do you understand? As insignificant as the anus is, you do every other thing. So I wouldn't release the excrete. Do you understand? So the point is actually that they all have equal level of relevance. No one, because it's just like those days when you are prepared, when we write exams, and you see some candidates with their presentation, their writing, you think they are fast. But take time to read it's all jargons. And you will see some people with a very horrible handwriting. But if you exercise a little patience to read the content, it's more valuable. right? So they all have equal level of importance. Please take note of that, because no one can actually, because if you say the form, the standard did not tell you what will be the component of a liability. So you can still carry a liability, report it as an asset. Maybe to have assets, liability, and everything. So you can carry equity, put it in liability, and just maneuver everything. At the end of the day, users of the financial statement will not be able to make any informed decision. See what have been happening before, what do you call it? Introduction of IFRS 9. You understand? It's one of the most topical standard as we speak. The standard says, IFRS 9 says that even the cash you have in the bank, looking at certain variable, has been impaired. Even though in our day-to-day communication, we still agree with it, but when we want to report it, we say no. The 1 million naira I have in my bank account 5 years ago, even at the beginning of this year, does not command the same value as at today. You understand? But IS1 will not take you that far. It will just say, report this as expense, report this as income, report this as this. When those ones now come, they take charge. IFRS 13, fair value measurement. I have a plot of land I bought 17 years ago, maybe at 500,000 naira. What is the worth of the land? It could have been several billions. You won't be able to bring in that differential into your book if you don't adhere to IFRS 13. IS1 will not tell you anything. Do you get that? Look at inventory as it appears, IS2, right? You bring in your inventory we are receiving to store at various times. You don't know which one you have issued first, and you have acquired them at various values. IS1 will not tell, even though it tells you that it's an asset, right? It will not tell you how to value such assets. Do you understand? So each and every of those standards have their own and equal relevance. Otherwise, the users will be misinformed, right? And as an accountant, I plead to you, take your time, whether through training of this nature or personal study, to have a good understanding of those standards. At least a fair knowledge of every of those standards, particularly wherever you are working at the moment, every standard that relates to your, because not all of those standards will be affected by what you do. As we speak now, one of the other very troublesome standard is, aside IFRS 9, is IFRS 17, specifically for insurance, right? Anybody who is not immediately working in insurance space may not need to, but it will sell you well. You know why you need to know it? It will sell you well because as you work, you might have engagements with insurance company. Your company might even want to invest in an insurance company, and they say, you know standard very well. Can you advise us in this area? So it's not at that point you would then be running to say, let me go and flip through. So you never can tell when the relevance of that your knowledge will be put to test. So take your time to equip yourself with the relevant skills. So what are then the things that are within the scope of this standard? I hope I'm not too fast. No. IS1 revised provides the following as scope of the standard. Number one, this standard is applicable to entities in preparing and presenting general purpose financial statement in accordance with IFRS, right? Remember, we've said that with effect from that transition in 2001 globally and 2011 to 2012 in Nigeria, we use that word interchangeably. IAS, IFRS, they are the same, right? So everyone who is attempting to presenting financial statements for general purpose, I keep on saying general purpose, because I've had instances whereby you are in an organization and your MD, who is looking at impressing the stakeholders, might say you acquire an asset or you incur a major expenses, and you say, I can't capitalize it because you want to have an impressive result. Do you understand? So because they have their intended or unique use for that, you then have to look at the impact, whether looking at your ethical values, whether you want to adhere to it or not. But as far as the general purpose is concerned, there has to be strict adherence to this. We've had instances whereby we have accounts, audit opinion qualified or giving an adverse opinion because of issues of this nature. So that's that. The second one is that the standard does not set out recognition, measurement, and disclosure requirement for specific transactions and other events. There are specific standards that caters for this. Remember I said it. You will not see anything like how do you measure an asset or any element of the account within the scope of IAS1. It will tell you this is how you must do and all of that. It will tell you how do you disclose, how do you, at what point do you recognize. For example, a company commenced operation on 1st of August 2021, but has incurred assets. They have a land and building and other PPE that which they want to start a business with. They've been incurring it as far back as 2010. At what point will you recognize that in their book? All the past costs, even though they were just incorporated and commenced operation on 1st of August 2021.
If you recognize the business that
Okay. What informs that decision?
Based on the standard.
Which of the standards? Which of the standards? They are, at least. If it is, because it's a PPE, go and check IAS 16. IAS 16 says all the costs you incur on a PPE from 19 Gbogboro till the date it was actually put into economic use, you have to recognize it on that date. And I put this to my listeners, that you need to have a broad perspective to life. You could be a cost officer today, you could be a compliance person today, but as nature places its card, you can be open to a CFO role. Do you understand? What makes a CFO role is not ability to prepare financial statements. You need to have a blend of all of these standard financial advisory, then most importantly, tax, because tax kills business as fast as possible. So it's not when that opportunity now remains very glaring that you prepare yourself to it. Those who see as MDs of companies today, it's not accidental. Do you understand? So start training yourself in putting the necessary skill within yourself now, such that you will be the best candidate or be able to perform better even if you find yourself in those roles. Do you understand? So the second one, just like I've explained, the standard does not set out any recognition criteria, measurement criteria, disclosure requirement for specific transactions and other events. So for you to know, how do I recognize? How do I measure? How do I disclose? You ask yourself, what is the event going on? Is it an asset? Is it a liability? Is it a provision? What is the standard on provisions? No. 37, IAS 37. So you need to know each and every of those instances, right? And make sure that you are adhering to what the standard says in meeting those appropriate faithful representation. Then the third one, the standard applies to all entities, including those covered by IFRS 10, that is consolidated financial statements, and those that that present separate financial statements in accordance with IAS 27, separate financial statements. This standard does not apply to the structure and the content of the condensed interim financial statement prepared in accordance with IAS 34, interim financial reporting. Now, what are we trying to say here? What are the companies that fall into the bucket of IFRS 10? These are entities that have controlling interests in other entities. You could still have controlling interest in other entities and still not adhere to IFRS 10, because IFRS 10 actually gives certain conditions where you might not consolidate. If the company is a subsidiary of another company, you might choose not to consolidate, even though you have controlling interest in other companies. Even though you might not be a subsidiary of other company, but you have controlling interest or even absolute or 100% interest in other companies, you might still not consolidate if you are not a quoted company. So those conditions are there. So you need to know at what point do I apply IFRS 10, at what point, if I don't have that, if I'm open to utilizing the exemptions under IFRS 10, I would then be recognizing or making my preparation in line with what? IAS 27. So what I would then have is that under my PPE, I will have investments in XYZ, investments in this, investments in that, right? So try as much as possible to have a good understanding of this. I'll take that again so that we can have it sync very well. This standard applies to all entities, whether you talk about government entities, whether you talk about private entities, whether you talk about NGO, as far as you are into a commercial activity for profit or non-profit motive, you are expected to adhere to this standard. Even if you have a school or church, you still are expected to adhere to this standard. Is that clear? Any question? Any question? Can I go on? All right, so the fourth one. This standard uses terminologies that is suitable, apologies for that is suitable for profit-oriented entities, including public sector, businesses and business entities. If entities with non-profits, not-for-profit activities in the private sector or the public sector apply this standard, they may need to amend the description used for a particular line item in the financial statements and for the financial statement themselves. Who can tell me what the standard is trying to talk about?
Okay. Trying to say that the standard uses the note that is multi-purpose, like it's universal. Every aspect of business, the business, the profit, or whatsoever thing you do that requires you to prepare.
But there is a caveat that they may need to amend the description used in a particular, for particular line items.
Yes, you know, every company based on the industry have a chart of account. So, what is obtainable in the logistics?
Yeah, but it's not looking at it like that. Even though that is very correct, it's not looking at it like at it that way. It's looking at it in terms of not for profits making and public sector. You know, in public sector, you will not have equity. Do you understand? Rather, you have subventions and the like. So, which is where you are also right. The nomenclatures in insurance will not be totally the same with maybe banking or trading and the likes. But what it's just saying is that you group all the private sector as one, the public sector as one, and the NGOs as one. Right? Then the fifth, this standard may also be used by entities that do not have equity as defined in IAS 32, financial instruments. What is a similar standard to IAS 32? Yes, but the very closest one before IFRS 9 come to play is IAS 39. But there is a standard that partially replaces IAS 32. IFRS 7, financial instrument presentation. While IFRS 9 partly replaces IAS 39. So this standard may also be used by entities that do not have equity as defined in IAS 32, financial instrument presentation, e.g. some mutual funds. You know, entities that they call mutual funds, they don't have capital. They only have group of funds or donors that come together, invest in something and just share the returns upfront. So it's saying that you can still use it for such entity, and entities whose share capital is not an equity, e.g. some cooperative, even business name, all those entrepreneurs, I mean, all those sole proprietors, partnership and the likes, may need to adapt the financial statement presentation of members or unit holders' interests. So those are the basic and relevant ones you need to know about the scope. As few as it is well loaded. So we're looking at, before we go into the main provisions of the standards in proper, because we'll be using some terminologies as we go on, and those terminologies may not have the same meaning as we have been used to in our general or layman's engagement. So let's look at the specific definitions of what the standard has given to some key items as we go on. The revised IAS 1 provides definition of terms used in the standard, some of which were extracted and explained below. 1, general purpose financial statement. Remember, I've been using the word the expression general purpose, general purpose. What does it say it means? This means financial statement prepared to meet the need of users who are not in a position to require an entity to prepare financial reports tailored to their particular information needs. So when we say general purpose, tax officials, say for example, the tax authority, they won't come to any company or go to any company and say, prepare an account specifically for me. Do you understand? So they are part of the general users. So what you will have to do is when you are preparing your financials, you should have it at the back of your mind that these people and so many other stakeholders may use it. So in making your presentations and the content therein, ensure that you have factored their needs and the information is presented in a way that will make it very explanatory without having a need to say, oh, Oga, come and explain what you mentioned here, right? So that is what a general purpose means. So you need to factor, if you feel that, oh, tomorrow you will need an investor, what are the information an investor will need in your financials? Put it in today, right? If tomorrow you think that, oh, you probably might want to merge with another company, what are the things that you think they will need? So management or the directors will have at the back of your mind, who are the users of all these informations? If we factor the need of your staffs too, because as employee, you still need the financial information too. What are the things that you'll be looking out for there, right? So that is the meaning of the general purpose financial statements. The second one is impracticable. Impracticable, what does it mean? Let me get your view first. At what point do you say something is impracticable within the context of IAS 1?
Okay. If something is said to be impracticable, means probably it defines certain conditions that make it not to be enforced.
Okay. Do you have any view?
What I meant any access to either the IS one or the fine, rather like it is not in line with what the standard demands.
Okay, let me hear your view, Lizzie.
For that particular occupation, the occupation does not have what it entails to carry out
You're almost there, but you're not using that term. Go. Okay, what the standard wants to ensure is that you have tried to use it, but it's just not applicable to your situation. You know, somebody could, because IFRS 9 is very complex, a lot of companies will say, I'm not using a job, because they don't want to be subject to that rigorous process. That doesn't mean that it is not practicable. Do you understand? But if you try to apply it and it still did not meet your expectation or a fair representation, you then say it is impracticable, right? So let's look at the wording of the standard. Impracticable, that is a provision of the standard which an entity finds difficult to apply after making every reasonable effort to doing so. So there must be an evidence that, oh, you have put an effort in place. And that is where the standard now says you can then use your judgment. If you think doing what this particular standard says is not visible, say for example, IFRS 13 says you should do fair valuations, Abi, and the total worth of a company is, let's say, 25 million. And that valuation you want to do, the valuer say they want to collect 25 million to do that sort of valuation, or even more. Do you get it? Depending on the peculiarity that you have, you will notice that the first question you are, even if it is not 25 million, let's even say it's even 5 million. No management want to spend that money, that kind of money, on something that does not bring real value. Do we want to sell that thing now? No. So why will I spend as much as 5 million on something that is not bringing me a definite value now? So whoever that is now preparing that financial statement, you know, in our disclosure, we'll have said that we comply with all the standards. So what this is now saying is that we have complied with all of the standards except IFRS 13. Because of this, as a result, we have used this particular whatever, or we have just retained the historical costs. That is why now FRCN has now come up with a publication in, I think, about 2 weeks ago, that for all auditors, when you are auditing SMEs, don't use IFRS. Yes, because IFRS actually requires a lot of disclosures that compliance could be very, very expensive. Say, for example, when we want to do an average audit, you can do an average audit for 2 million naira. But if that clients have never complied with IFRS 9 and you want to do all those modeling for them, it can be as much as 5 million naira. So the management will ask you, the whole work you want to do is 2 million. This one alone is 5 million. What is the value to me? Is it that my regulator imposes me to doing it? If not, why do I have to spend that kind of money? Do you understand? But if it is a kind of requirement that is enforced, that is recommended by the standard and further enforced by the regulator, you then know that if I don't comply, I can't operate in this sector. And that is why entities that are regulated have minimum capital requirements, such that basic things you need to do, even though it might look expensive for other companies, it will be immaterial for you. So what then should auditors or accountants use when you work for SMEs? there is a distinct standard that has less disclosure requirements, which we call IFRS for SMEs.
Oh.
Yes. Do you understand? So when you are preparing, but the FRS, they are still trying to work things out. The standard is there already as issued by IASB. We're just adopting it. But what they have failed to tell those in practice is that what is the definition of an SME? Because if you look at various aspects of the law, it gives different valuation for SME. If you come to tax now, tax says you are a small company if you are doing turnover of less than 25 million. But you're a bit bigger if you are doing 100 million. Do you understand? But there are a lot of companies that are doing even a billion. They will still call themselves SMEs. Do you understand? When you get there, say, we are small, we are turnover. But if there have been a distinct circular about, okay, the moment these are the characteristics of what makes an SME, maybe in terms of turnover, maybe in terms of this and all of that, then it will now be clear, right? Because of and a lot of companies too, they are doing several billions. Because they are not operating in the regulated industry, they will still say, okay, I'm small now, what is wrong with you? Do you get it? So it is important for you to know that that transition or that expectation is now out there, but let's now be on the lookout to whether the FRCA will actually give further directive or what actually makes an SME, or whether they want to actually leverage on what it has been disclosed or contained in the Finance Act. If they want to say, oh, we are going by that definition, then everybody knows that when you have accounts of 25 million or turnover of 25 million or 100 million, they are all SMEs, right? You know, in the recent Finance Act, particularly Finance Act of 2019, states that companies are now classified into three for tax purpose. One, those who are doing less than 25 million, you call them small companies. Those who are doing above 25 million but below 100 million, they are medium-sized companies. Then anything above 100 million, they are large companies. 2019. It was further re-emphasized in 2020. You know that 2019 is what actually gave amendment to that VAT Act. Yes. So that tells you that if that act started from February of 2020, then it is a Finance Act of 2019. So next one, what is the definition? What is the standard? What interpretation did the standard give to the word or expression International Financial Reporting Standards? I think this will now further broaden our mindset, because anytime we mention IFRS, people just believe it's just IAS and IFRS alone, right? But look at what the standard calls it. These are standards and interpretations issued by the IASB. They comprise, one, the International Financial Reporting Standard, the general one you know. Then it also contains International Accounting Standard, all the one from 1 to 41 that you know. Then it contains what we call the Ifrs interpretations. What is the full meaning of Ifrs? Committee. Then what about SIC interpretations? Okay, good. So remember that those days when we are using IAS primarily, whenever there is misconception or misinterpretation of the standard, there will always be SIC interpretation that clarify what the intent is. So SIC is to IAS, while IFRIC is to IFRS. Please take note of that. So anytime, as far as IAS 1 is concerned, it's expected that when you say IFRS, you are not just picking the IFRS or the IAS, but you are picking alongside their respective interpretations. Then the fourth one, material. What is material within the plight of IAS 1? It says that information is material if omitting, misstating, or obscuring it could reasonably be expected to influence decisions that the primary users of general purpose financial statement make on the basis of those financial statements, which provide financial information about a specific reporting entity. So they still did not say exactly whether this particular threshold makes something material or immaterial. But anything that you feel that, oh, if an organization is making a turnover of 5 million, right? And on a particular day, they did not disclose, a particular transaction is about 2.5, they did not disclose it. Will it affect the decision that a company will have made on it? Say, for example, again, there is another company that makes an annual turnover of, let's say 60 million, but one particular transaction is 40 million, and they didn't disclose that. You know, Ifrs will have simply say, they are small. So that is what the standard is saying, because by that singular omission, you will have, whoever that is using that information will have made a wrong conclusion. Do you understand? So the following are factors which could indicate or result in material information being obscured. So these are the things the standard has given as guidelines. It didn't give you specific value, but it gives you things that you should look out for. Information regarding a material item, transactions or other events is disclosed in the financial statement, but the language used is vague or unclear. You might still disclose the financial the correct information there, but in Nigeria, our common language is what? Our business language is what? In Nigeria? English. Abi? Okay, so if I now prepare an account and I put it in Chinese, so it's a material, because whoever that should use it will still not be able to use it. You might be surprised that, oh, could that be a perfect example? I have some Chinese clients that whenever they prepare their financials, it's not in Nigeria, it's not in English, it's in Chinese. So you will now have to sit them down, say, okay, help us translate this to that. So that is a material, that will have a material impact. Now, information regarding a material or other events are inappropriately aggregated. You might still have disclosed the correct thing, right? Imagine, let me give you a typical example. I sell computers, right? And I made a sales of 40 million in a particular year. No, let's say 20 million in a particular year. And I then made an interest income on my fixed deposit with the bank, 35 million. But when the auditor or the accountant was reporting it, they didn't report trading income and interest income. They merged everything together. Don't you think that when Ifrs will pick that wherever, they will insist that, you should pay VAT? Meanwhile, interest income is not VATable. Do you understand? So that's what that is a typical example of what they might be referring to, saying that information regarding a material or other event are inappropriately aggregated, because they should have been separately disclosed. If you have disclosed it separately, whoever that wants to make use of that information, including Ifrs, would have been able to make a better judgment. Do you get it? Then the next one is dissimilar items, transactions, or other events are inappropriately aggregated. Things that don't look alike at all. You decide to merge your expenses with your liability and you throw it somewhere. That will result to a material misinformation. Then similar items, transactions, or other events are inappropriately disaggregated. You know, we've talked about aggregated. So if they are similar transactions and you unnecessarily disaggregate them, then it could still give us misinformation. You have, what are the various components of your staff costs? You could have basic salary, allowance, medical, whatever. You just split them anyhow on the face of the account. Whoever that wants to know what, for the purpose of determining your ITF contribution, for example, the user will now be looking for, and they might miss one or two, thereby making a wrong assumption. She understands. So what are not the same, if you aggregate them unnecessarily, you can still misinform the public. And what are similar, if you disaggregate them unnecessarily, you will still misinform the public or the users. Is that clear? Then the understandability of the financial statements is reduced as a result of material information being hidden by immaterial information to the extent that a primary user is unable to determine what information is material. So this one, you are now combining what is material with what is not material, right? And reporters do these things because of various reasons. Okay, let me give you a typical example. We've seen this in practice sometimes when we go for tax audit. You know that not all donations are allowed. And you have made a donation that is not material, but you don't want it to be disallowed for tax purpose. You now want to go and hide it inside entertainment or inside corporate gifts. Do you understand? Wherever that will have been able to pick that out, if you have separately disclosed it under the aggregated heading, will not be able, because sometimes when you are making your self-assessment, they'll just look at all the figures. But if you have separated it, it's like, oh God, what is wrong with you now? Who do you actually make this donation to? Is it a recognized institution or not? So things of that nature could also be, right? Instances whereby, and a lot of accountants do this. When they do a lot of jomo, they've spent unapproved amounts. They will now go and put it. Please don't do it too. All right. So still under it, we have said several times that when you prepare financials, you need to make disclosure in the notes. So you need to make disclosures in the notes. What then is note according to IAS 1? The standard defines it as this contains information in addition to that presented in the statement of financial position, statement of profit or loss, and other comprehensive income, statement of changes in equity, and statement of cash flows. Notes provide narratives, descriptions, or disaggregations of items presented in those statements and information about items that do not qualify for recognitions in those statements. So what are we saying? When you have instances, most of the values you have on the statements of financial position and other statements are usually in total. But if you want to see what actually makes it up, right, you then need to go and check the notes. That's what the standard is trying to say. Then other comprehensive income, we often mention other comprehensive income. Remember I asked a question, what are the things that will be here and all of that? So this is where the standard attends. This was not there before. It just left us to decide our fate. But now the standard has taken its time to expand what should be here and what should not be there. Other comprehensive income. This comprises items of incomes and expenses, including reclassification adjustments that are recognized in profit or loss as required or permitted by other IFRS, right? So what you will have there can still be an income, can still be an expenses. It now goes further to say the components of other comprehensive income include: 1, changes in revaluation surplus according to IAS 16, that is PPE, and IAS 38, intangible assets. So we have an asset that we have acquired so many years ago, maybe the value after revaluation as recommended by the standard. You know, there are various methods that you can use in valuing your assets here, according to IAS 16. So one of those methods is revaluation method. You have revalued the assets, you know their current value, whether an increase or decrease. Where do you then, if it's an increase, you know, let's put values to it. Let's say the asset was 10 million before, now it is now 55 million. You will have had your asset balance being 10 million. So in recognizing the gain, now that revaluation surplus, you will have to still debit the asset with the difference and credit what? That revaluation surplus. But the standard is now saying that gain should not be reported in OCI. Do you understand? What we do in the days of SAS is just, we just take it to revaluation surplus, which is a balance sheet item. Do you understand? It's not reported on the face of the account at all. But this is saying we need to make that transitional trail and auditory very visible. So let's see how it becomes a gain, and let's see the impact of it. And how is this different from the regular gain or losses that occurs on the day-to-day activity. Then other thing could be remeasurement of defined benefit plan according to IAS 19, employees benefits. Remember that according to IAS 19, there are two forms of benefits. You can decide to say you are using the regular pension plan you are using at the moment. That one is not reflected in your book at all. As you make the contribution, you expense it and it goes. But the other one is where the company actually maintain a defined benefit assets. You are making that contributions, but you are investing it in a venture. Do you understand? Let's say here we are, and this is an audit firm, but let's assume that it's our policy that, oh, the defined benefit plan we have for our staff, we reinvest it in a real estate. Maybe we bought a land somewhere and we're developing it and all of that. If for any reason, in line with this standard, you have to remeasure the value of that, of that investment, it can lead to an increase, it can be a decrease, right? So this standard is now saying that that remeasurement, which could be gain or losses, should not be reported on our regular profit or loss account, but rather in the OCI, because it is outside our main day-to-day operations. Gain or losses arising from translating the financial statements of a foreign operation according to IAS 21, the effect of changes in foreign exchange rates. So this one occurs very often where you have to do translation, restatement, and all of that. Sometimes you have the gain, which could be unrealized or realized as the case may be. So it will be treated as an OCI item. Then gain or losses arising from investments in equity instruments designated at fair value through OCI in accordance with Ifrs 9. So when you invested in equity of other companies, you bought shares of other companies. So gain or losses that arises on the capitalization value of that very investment will be recognized in the OCI, not on the regular statement of profit or loss. Then you have effective portion of gains or losses on hedging. Who can tell me what hedging means?
Okay.
Let me say, foreign transaction, when we say hedging, it means there is a possibility that the prices as it is today might be different in later in the future, and which might make some transactions like that future. If you don't need hedging, it means a way of trying to avoid the losses or
You're right. It can come in either ways. Sometimes it can be a gain, it can be a loss. But I like bringing my examples home. Even though a lot of us in Africa, and Nigeria in particular, we forbid this. When in the north, as early as age 5 or even less, they've given out their daughter in marriage. What they are actually practicing is aging. Because that lady may not have a suitor, may or may not. You understand? But we've edged that risk that, oh, this is your husband. At the due date or when you are ready, come and carry him. Sure, you understand? So that is a very simple. If you remember that illustration, you know everything about edging. Edging, a typical example also is this. Let's assume I manufacture this TV, right? I manufacture 100 and I have an hotel who will be starting business maybe in 5 years or 2 years or even a month, but I've not even completed my manufacturing. They now come and say, okay, before you even start your production process, we'll be needing, we have booked, not that period, a lot of people will now be rushing, you now say, no. So edging sometimes can also be taken as a way to secure transaction for your products. Do you understand? Because you already know that no matter what, you have a ready-made buyer for those productions and all of that. So let's look at it in this context. Effective portion of gains or losses on edging instruments. So it could be anything. You could edge anything, right? Instruments in a cash flow edge, and gains or losses on edging instruments that edge investments in equity instruments measured at fair value through OCI in accordance with Ifrs 9. You know that there are some times that you have some debt instruments, somebody has borrowed you money, right? And you have embedded in that contract that, oh, if you so like, you can convert that particular instrument, that particular debt instrument into equity. Okay. Sometimes you could have agreed beforehand that, oh, I'm not going to pay you the amount though at the moment I'll be paying you interest, but when it's due, we are converting this debt instrument to equity at so price. We'll have agreed beforehand. Sure, understand? So we will talk more about that under IAS 33. What is IAS 33? Yeah, any partial. That is what brings about dilutive and non-dilutive and the likes. So for particular liabilities designed as at fair value through profit or loss, the amount of the change in fair value that is attributable to the changes in the liability credit risk according to Ifrs 9. So when you have financial liabilities, what a lot of people actually know is financial assets. So when you have gain or losses arising on financial liabilities of this nature, where you actually also report it is on the OCI. Then changes in the value of forward elements of forward contract. What's the forward contract? It's very similar to that of edging too. So you have agreed the terms of the contract as of today, even the price today. Okay, so when separating the forward element and the spot element, what is the spot element? The amount, okay, good, of a forward contract and designating as the edging instrument. You can see that I told you there is an element of edging inside. Only the changes of the spot elements and the changes in the value of the foreign currencies basic spread of the financial instrument when excluding it from the designation of the financial instrument as the edging instrument according to Ifrs. Now, what are we saying? What we are saying is that by the time transaction is eventually consummated, you know, you could have also had a gain or loss. Because if you have agreed the price beforehand and the price eventually fall, you will have lost because you could have bought it cheaper. But if it's on the other way around, then you will have gained, because if you have not made that earlier agreement, you will have bought it more expensive. That differential which could be a gain or loss, should be reported in OCI. Because you are not primarily into the business of making that kind of, do you understand? So where your role will then be very relevant as you continue with your work, whether with your current employer or other ones, is when you pick out issues of this nature and you are able to profile solutions on how it should be treated. And the management double check. As I don't doubt this man, Timothy, I don't know him to be that experienced. And they double check and notice that it's correct. Before you know, you open yourself to greater and more responsibilities. Do you understand? And that, of course, affects the bottom line. But when it happens, don't forget me. All right. So insurance finance income and expense from contracts issued within the scope of IFRS 17. IFRS 17 is a very, very, very sellable standard now. In fact, everybody is still like running after to get in the nitty-gritty because it is fully operational now. IFRS 17 insurance company excluded the profit or loss when total insurance finance income or expense is disaggregated to include in profit or loss an amount determined by systematic allocation applying paragraph 88 of IFRS 17, or by the amount of elements accounting mismatch with the finance income or expense arising on the underlying items. A lot of complexities are involved in IFRS 17, but let me just tell you the whole essence of IFRS 17. There are some insurance components insurance policy that you take that you know beforehand, this is my gain. Do you understand? Because nothing will reverse, right? But what policy do you take? What annuities or permutation do you make now? If somebody take a life assurance policy, how do you know what when the loss will crystallize? So it becomes very difficult for you to even recognize your gain today because there is no gain. Do you understand? The gain will only be deferred till when that a short period had then elapsed. So, but it is different from this regular insurance policy that you just take a third-party insurance policy that nothing might not even occur. So the peculiarities involved, it's very uncertain. So when gain or losses crystallize in this form, the standard is saying that gain or losses in that regard should be reported in OCI. You will notice that this particular provision of the standard is very detailed, right? Before, they just left the whole practice to use your judgments to decide where it should be and what should be the determining factor. Changes in the value of time value of options when separating an intrinsic value and the time value of an option contract and designating as the hedging instrument only the changes in the intrinsic value according to IFRS 9. It's not far-fetched from what we have said before. You know options now. What are options? It is not as enforcing as hedging or forward contracts. You have the opportunity to exercise the rights if you so wish. Do you understand? Of course, if we have an option now that say within this period and December, you can buy this TV at a price of say 400,000. I will only exercise the right if I see that the price of this TV has skyrocketed above 400,000. If it's below 400,000, do you think I will exercise the option? So what they are saying is that if you then have, which is more likely to happen, is a gain, because I will not exercise an option if it's loss. Do you understand? I won't exercise. It doesn't make any economic sense for you to have agreed that, oh, buy these things at 500,000 and you see it being sold at 300,000. Why will I exercise the option? So things of this nature could most likely crystallize into what? Into gain. Then finance income or expense from reinsurance contracts held excluded from profit or losses when the total reinsurance finance income, when the total refinance income or expense is disaggregated to include profit or loss, an amount determined by the systemic allocation applying paragraph 88 of IFRS 17. So this is also not far-fetched from what we have earlier explained on insurance. You know the insurance concept where a particular insurance company also reinsures its risk. So the eventual losses or gain that will also crystallize from that, you have to report it in line with this. So these detailed provisions or guidelines will then regulate how accountants that eventually meet this thing in reality, where they will what? Report it. Do you understand? Wherever that is not abreast of these updates may still tentatively go and report it on the profit or loss. Meanwhile, it should be where? On the OCI. So that is on that as far as what will be the components, the definition of OCI and what will be the components of OCI. Please, I will encourage you that don't, after today, don't just leave this thing, because the further you leave it, the more. The question I ask, the question some people ask me is that how come you're able to, because about 90% or 95% of the whole standard I can recall offhand, how am I able to retain it? What I do is that I make meaningful engagements with people. Do you understand? If you, just as you have read it now, your colleagues that you know that you have this kind of regular discussion, engage them in that discussion regularly. Do you understand? As you engage in the discussion, the more it sticks. But if you just read something on your own, the tendency that after some days you will forget is very high. But if you have involvement, and this is another thing I do, I don't limit my discussion on topical issues in the practice to my immediate colleagues alone. I even involve others in other things, because in this our practice, you can work for 30 years and not have encountered some of these things for once.
Limited to the area.
You may limited, but mind you, you have friends in audit, you have friends in finance, you have friends in insurance and all that. So imagine you just engage somebody in insurance or financial advisory about some of these issues. They might not even be looking at it the way you are looking at it. Do you understand? So because of that meaningful engagement, they will go back to check if they are performing that financial reporting role. You will have added more value to them. You will also have what? Gain much more, because the day next discussion will just come. Just remember the last discussion you have. You will know the thing will surge back. That is the best way to learn things. All right, owners is a common word, but the standard decides to give its distinct definition to it. It says these are holders of instrument classified as equities, right? So this then will tell you that if I have preference share equity, am I an owner within the context of this definition?
Yes.
I am.
Yes, you're right.
You need to go and study IAS 37, that talks about provisions and liabilities and contingencies, right? Because the context of liability in that standard had already been defined to include preference share. Remember we said, don't use this standard alone. Use it in consonance with others. So quickly you will just like remember, okay, is there any standard that talks about that very thing? If there is one, what did the standard says about it before you jump to conclusion here? So because of that singular interpretation, except where there is now an amendment to IAS 37 that further defines now that preference share equity holders is not a liability. There could also be an argument because there are various types of preference share. If you then have a redeemable preference share, an irredeemable preference share or a convertible preference share, it can then be as good as equity holders. Because what makes it irredeemable is that they will never buy it back from me. Do you understand? So I'm as good as the major stakeholders. Is that clear? So profit or loss, what then is profit or loss? It's also a very common expression. This is the total of income less expenses, excluding the component of other comprehensive income. Before, they just say it is income or whatever. We are now separating it that don't say it includes OCIU. And remember all of those long explanation we have made about what constitutes an OCI will never be regarded as profit or loss. Even though some of them might lead to gain, mind my word, you remember I don't use the word profit or loss. Some of them might lead to gain or losses. Sure you understand? So please take note.
The OCI. Any like grants received from the government or
okay, so this is the way we answer this kind of question. Anytime a standard gives you a list of items that should be in this category, and you don't have that particular thing mentioned, it means it can never be there. So if you recall, all of those things we mentioned, do we see grants there? So it means grants will still be treated. There's a lot of complexity around grants. So what is the standard on grants? Yes, 20.
20.
So, you know, there is a lot of complexity around grants because grants can be in the form of an asset. It can be in the form of cash. Yeah. It can be for a defined period. It can be for a staggered period. So if it's for a staggered period, you cannot recognize it as an income in that year. You will only spread it. You will suspend it in your balance sheet and now be writing it off the way you are depreciating whatever over the period. Sure, understand? And if you go to that same standard, that standard will have further told you that, oh, it is never an OCI item. Is that clear? It's in regular profit or loss. Yes. You just report it as other income. And if you're the one that gave that grant, you report it as an expense. That's the thing is very interesting, Abi. It's more interesting when we now merge it with tax. All right. So reclassification adjustment, because when you now see that you are changing your accounting policy, the standard actually introduce another policy that warrants you to reclassify from an existing disclosure to another one. You will then need to adhere to this. So reclassification adjustment, these are amounts reclassified to profit or losses in the current period that are recognized in other comprehensive income in the current or profit and previous period. Yeah. So what meaning can you give to this?
Okay. Probably an event which based on assessment should fall in the OCI. Certain information is brought to form which needs to be classification.
Okay, a better way, we will have a detailed discussion around this one will be taken in our next topic, IFRS 1, first time adoption of IFRS. Most definitely, what the standard says is that if you are adopting IFRS for the first time, it's either you have never used any standard at all, or at least in Nigeria, you've been using SAS. And if in your SAS, there has been a particular categorization, okay, one of the unique things you will then meet is the distinction between IFRS 5 and IAS 41. What is IFRS 5? How is it different from 41? What is 41?
IAS 41.
Okay. How is IFRS 41 different from IFRS 5?
The properties that we expected and our expectation is
I didn't get you.
Okay. What is the investment property? That the properties we have that maybe our expectation is.
Okay, let me explain it better. You actually mix it wrong. I mean, get it wrong. IAS 41 is agriculture.
Okay, it's got.
So I actually wanted to test you on that. So the concept of agriculture is a different thing entirely. So it is now IAS 40. Now IAS 40 could almost be, in layman's view, you will have looked at it like it is normal PPE now. There is no differences between them. But there is a distinction between IAS 16, IAS 40, and IFRS 5. IAS 16 is your general PPE, which can be your plant and machinery, your motor vehicle, office equipment, computer and equipment, and the likes. Now, but anytime the management don't have any intention to continue to use any of these class of assets, except land and building. Please read my lips, except land and building. Anytime they don't want to use it again, they rather want to sell it for any purpose, you will derecognize it in IAS 16, that is PPE, and take it to non-current asset held for sales. Now, because I said it is except land and building that is not used for the primary purpose of the business is always classified as IAS 40. So say, for example, let's assume KCP hold this building, but the only part of the building that we use for our business is these flats. Okay. So the treatment we will then give to you, this portion that we are using for this particular whatever, we then form part of our building cost as PPE, IAS 16. Are you getting me? Because the whole thing will be separated, right? The portion that we use for our day-to-day service qualifies as our building. Now, the other part, maybe we sublet it, right? That then qualifies for our investment property. So investment property is usually land or building, or the two, that is used, that is either made available for sale or used for rental purpose. Do you understand? But provided you are also not a real estate. You know, in a real estate, the main purpose for which you are in business is to sell land and building. In that regard, the land and building you then have will not be your PPE. It will rather be your inventory. Do you understand? So you need to have that understanding. So if, as a result of your adoption of IFRS or the IFRS for the very first time, or because of the introduction of a new standard, you then need to reclassify an expense from a previous version or nomenclature to another one, or an asset from one category to another. The standard is saying that we call it here reclassification reclassification adjustment. Is that clear? But how you will then treat it will be in line with what that particular, the standard on that particular item, in addition to IAS 8. Do you understand? Sorry, somebody is disturbing me here. Okay, so let's go on. Then I think the last one under the key definition of terms is total comprehensive income. What then is the total comprehensive income? These are the changes in equity during a period resulting from transactions and other events other than those changes resulting from the transaction with owners in their capacity as owners. You know, one could have been tempted to saying the addition of the profit or loss on profit or loss accounts and that one, but that is not the definition it gives to it. Even though that is still what they are saying. So it's actually the addition of these two, but the standard did not define it that way. That addition actually is what is attributable to the equity owners. But this is the way the standard has choose to explain it. Any question as we go on? Okay, so what then is the purpose for the financial statements? The standard emphasizes that there are users of the financial information. We could be the investors, it could be the employees, it could be the government, name them, it could be the bank, name them. So anytime you are preparing financial information not for a particular purpose or a particular group, it is called a general purpose account or financial statement. Now, the financial statement shows that this kind of financial statement, because everything we've been talking about all the while is not management accounts, right? Is accounts, financial statement prepared for that general purpose. Financial statement shows the result of the management stewardship of the resources entrusted to it. It is a structured representation of the financial position and the financial performance of an entity. It then provides information about the assets, liabilities, equities, income and expenses, including gains and losses. Where are they using the gains and losses? Mostly in the OCI. Occasionally, we use it in profit or loss statement too. Remember, where we have gain on disposal of assets. Good. Contributions by and distribution to owners in their capacities as owners, then the cash flows. So any financial statement you have must definitely at one time or the other talk about all of this, though in different segments. The financial statement assists its users, which is the main purpose now, assists its users in predicting an entity's future cash flows and in particular their timing and certainty. What makes a complete set of financial statements? When do you say you have, when you say I have prepared a financial statement, what the standard is expecting from you is to have all of the following, right? A complete set of financial statements comprise: 1, a statement of financial position as at the end of the period, usually 1 year. But the standard recognizes that you might choose to prepare the account for a period of more than 1 year or less. Why not? A statement of profit or loss and other comprehensive income for the period. It's either you are preparing it as a separate statement or you are preparing it as a total comprehensive income. Then a statement of changes in equity for the period, right? Then you have a statement of cash flow for the period. The first four, this one is also there, but before we get there, the first three is actually what will form the contents of each of those statements is as specified by IAS1. IAS1 will give us the content, right? But what informs the content of statements of cash flow? Who can tell me? What will form the content? What are the components of the statement of cash flow? No, seven. All right. So other components of a complete set of financial statements is notes comprising significant accounting policies and other explanatory notes. Then comparative information in respect of the preceding period, a statement of financial position as at the beginning of the preceding period, when an entity applies an accounting policy retrospectively or makes a retrospective restatement of items in its financial statements, or when it reclassifies items in its financial statement. So all of these are what guides how you eventually do all of these is as contained in IFRS 1 when you are doing it for the very first time, or IAS 8. Do you understand? Then there are some instances that IAS 10 also talks about it. What is IAS 10? Okay. Then also part of it is an entity shall present with equal prominence all the financial statements in a complete set of financial statements. Why did they say it must be in equal prominence? Watch out, most of the audited accounts you see or management accounts, even if the balance sheet is 2 lines, you cannot continue the statement of profit or loss on that same page. You know it is a common thing, but this is why they are doing it. Okay. This is an example of an audited account. You see each and every of these statements you mentioned now, they will be on separate pages. There are times that you could have said that this next page, why don't we continue here? You understand? If I do that, I will then have contradicted what the standard says, because each and every of those statements must have their equal prominence. If I pick this page, it must be for that one alone. Even if it takes 3 pages, the whole of that 3 pages must be for that one alone. Is that clear? Then, what are the general features? What are the general features of financial statements? What are the things that you must see before you say, oh, even though it contains all of the items or the components we have earlier mentioned, without any of this, you wouldn't have even been able to say you have prepared a financial statement in line with IAS 1. Fair presentation and compliance with IFRS. This is where the standard is now saying, though I told you to prepare all of this, or how you will prepare it will be dictated by other standard. Fair presentation and compliance with IFRS. So don't say if for any reason you did not comply with any standard, state it there that you have complied with some, and for this purpose, you did not comply with others. Otherwise, you will have conflicted what the standard says. Is that clear? Going concern, every financial statement you are actually preparing must measure the going concern of the company, right? You have those parameters that you have to use in assessing the going concern of the company. But the question I will have been expecting from you is that, what part of the statement will tell us about the going concern?
What part of what?
The statement. How? How does it talk about the going concern?
Looking at the, let me say, the essence of working capital, definitely about the inventory. So looking at
It can just tell you that maybe the company is having stiff cash flow or not even making a cash profit. It will tell you primarily, because when a company is just starting off or in some period in business, you have some unfavorable outlook. It still does not mean that they are totally out of business. Meanwhile, you can also have a company that have a fantastic cash flow, good profits, and they are good as dead.
What about IFRS 5? If most of the non-current assets are
Being held for sales. Okay. That may be technically correct, but it is no, it's very practicable, very practicable. That may be, because it's strange for you to have all of our assets disclosed, regarded as, but it can also be possible looking at the events of e-business these days. We can say we don't need anything.
Okay, instead of physical.
Because we don't need to be anywhere. So that is why I say it may be technically correct, but not totally correct. How? What will happen there before you can say you are going concern?
A business can still be running at losses and still.
Of course. Of course. One of the areas I will tell you is, first of all, the notes to the account. Imagine you have a client in the cryptocurrency last year. And while they are preparing the account, as part of, in line with IAS 10, that talks about you disclosing events after the balance sheet date. They now said it there that, oh, the CBN has made a policy that this business can no longer strive in here. So that tells you that this company, until when that policy is reversed. Then other areas will then be the director's reports. Because the directors will tell you that, oh, there is nothing that has come to their awareness to say that we will not be in business in the next 12 months. Do you understand? Or they may also tell you that, oh, this has happened. Though. I remember the year I qualified. I came up with this result, with this case study in advanced audit and assurance then. That there is this company, are you listening? That there is this company, director's report, that there is this company that they are into laboratory business. And they've been doing laboratory tests for a long time, and they've been just as popular as clinics. I don't know whether anybody knows clinics.
Clinics, yes.
And all of a sudden, they just did an HIV test for a particular patient, and mistakenly, they gave a wrong report.
Wow.
And that couple that they came, the patients there, they were about to get married. So because of that, whatever, one is negative, one is positive. So marriage scattered. Years later, one of them wants to that is how they frame the case study. One of them wants to change job. That one that was declared positive. The company, as part of the recruitment process, now had to do the test again. She did not disclose her status. They now found that the report is negative. Now go and do another one, negative. Go and do another one in different places, negative. now sue the company that you scatter my marital life. So the thing was in paper, the company paid through their nose, and because of that singular publication, the other regular clients of theirs were now withdrawing. That maybe we'll be the next person that will be affected. And the staff too look at the way things are going on, we will soon have no job. All of them start resigning. They now said, explain with a perfect accounting terminology how you can portray that company. Now, what suitable accounting concept, that was what they used, can you use to portray that what happened in that company? Their going concern is under threat because the customer says we are not doing again. Staff, the major staffs have resigned. They should just close shop. So when you have disclosures in the management report, the director's report or any portion of the notes that talks about business is hard to this and all that, they are technically just making disclosure around this concern, but under normal circumstance, every company account should be prepared with a going concern in mindset. But you have to test that going concern. Don't just say it is fine with them, right? You regularly need to assess what are those variable or factors that could have occurred, whether or companies in the Boko Haram state now, even though their business is still looking very promising, but because of economic factor or religious factor, they will be out of business. Do you understand? So the standard says this should be a unique feature of your financials. Otherwise, you have not fully complied with IS1. Then accrual basis of accounting for businesses in the private sector, you're expected to prepare the financial statement not on cash basis, but on accrual basis. But Ifrs now has now been introduced to encourage entities in the public sector to prepare their accounts on accrual basis, right? Or you're not aware?
I'm not aware. Either accrual or cash.
Majorly because but they lay more emphasis on accrual basis. Because if they still give that open-ended clause, most entities, non-government sector, government sector will still prefer to use their, and with that, you will not be able to do an objective appraisal of their performances. So materiality and aggregations. So we talked about materiality, that is amounts or disclosures or components of the account that are material must be given as right, while expenses that are similar but in immaterial form can then be aggregated. So, and we have also talked about instances whereby we cannot do aggregation. You cannot aggregate the similar items, right? You can't say it's expenses, salary added with repairs and maintenance. They are not, there's no correlation between them. Then offsetting. The standard gives instances where the offsetting can be allowed. But what is offsetting in the first place? Okay. So offsetting, the standard actually says that offsetting is not allowed except it is specifically permitted by another or a specific standard. Do you understand? So you can't say your liabilities and your assets, match them together and just disclose the net. No. That is why we have to say our revenue separate, our cost of the sales separate. Otherwise, we just have match everything and say gross profit straight. So frequency of reporting. The frequency of reporting says the standard did not say everybody should mandatorily prepare annually, but it says annually can be most reliable. But if But the most important thing is that consistency. So if you want to prepare every 6 months, let it be 6 months. But what we see most entities do because of convenience and comparability, we do annually, right? Comparative information, your financial information or your financial statements must not be without comparative information. There should be at least information about the prior year, except that year is the first year you are actually preparing the accounts. But in the absence of that, there must be comparative information. Otherwise, you have not fully complied with IAS 1. Then changes in accounting policy. When there is a change in accounting policy, that is governed by which standard? IFRS. Okay, so the standard makes it very clear that when you change your accounting policy, IAS 1 didn't tell you what to do, right? But it says that it encourages you to adhere to what IAS 8, and when you are also adopting IFRS for the first time, that is further talked about in what? Which standard is that? When you are taking IFRS for the first time, which standard talks about it? FRS. I thought you said FRS. Okay, so then when you are doing that, anytime you are doing change in accounting policy, it has to be retrospectively adjusted. Retrospectively says that you are making the impact adjustments on the prior year, right? You will see that being displayed in our next class, right? Because it is this major concept that IFRS 1 uses in doing accounting for that transition from the previous old standard to the new standard. So I will encourage you not to miss next week's class. Then restatement or reclassification, we've talked about all of this before. Then consistency of presentation. Consistency of presentation, whatever approach you started to use before, except the